Today we are going to talk about bank reconciliations. A bank reconciliation starts with the balance from the bank statement, which we will call balance per bank, and the balance on the books, which we will call balance per book. Now these two numbers are usually different. The bank reconciliation proves that those balances are equal other than timing differences and/or errors. We start the bank reconciliation with the balance per bank statement. Then about halfway down the page, we list the balance per book, also called the general ledger. We then find the reconciling items. How do we do this? We compare the bank statement to book and find items that exist only on one side or the other. For each item, we ask ourselves two questions. Question 1, which side has it and which side doesn't? And question 2, when the side that doesn't have it receives it, will it increase or decrease their balance? We then put that item in the section of the bank reconciliation that doesn't have it, adding or subtracting it based on the prior question 2. So let's look at the bank reconciliation for ABC Company. You can see that we started with the balance per bank statement of $21,573. This comes directly from the bank statement. Then about halfway down the page, we have the balance per book, which is the ending cash balance from the general ledger. We divide each section into add or deduct. We then find items from the general ledger that the bank doesn't have. Now in this bank reconciliation, the first item is a deposit that the company made, but the bank hasn't received yet. This could be because the company mailed it and the bank hasn't gotten it, or the company made it after hours. We call this a deposit in transit, and you're probably going to see it on every problem that we do. When the bank does receive it, their balance will increase, so we add it to the balance per bank. In the deduct section on the bank side, we first have outstanding checks. Outstanding checks you will also see in every problem we have. Those are checks that the company has written and taken out of the cash account, but the checks have not cleared the bank yet. In other words, the bank has not received them yet. Maybe the company mailed them and the recipient hasn't gotten them. You've heard the expression, the check is in the mail. Well, it actually happens. So when the bank gets them, they will reduce your account, so subtract them on the bank reconciliation. We should list each check separately with the check number and the amount, because in the next month, you have to check them off if they have cleared, and if they have not cleared yet, they are still outstanding for that month. We don't have them in this example, but another thing that occurs on the deduct side is automatic withdrawals if you have authorized the bank to deduct funds for a wide array of purposes. For example, you may instruct the bank to pay a bill for you. Now, reconciling items in the balance per book, also called the general ledger section, include items collected by the bank for the company. The bank may agree to collect a note receivable for the company, and the company finds this out when they get their bank statement. It may be someone in another city that you have the company has a note receivable with, and the bank agrees to collect it for you. What does this do to the company's balance? It increases it, so we add it. The bank also might have interest revenue on your balance in the account, so you would add that too. In the deduct section, there is an NSF check. NSF stands for not sufficient funds. A customer gave that check to the company, and the customer doesn't have enough money in his or her account to cover it. Now the company no longer has that amount in the account, so deduct it. Also, the company may have a service charge from the bank. Deduct this also. Notice now that the adjusted balance per bank of $22,437 equals the adjusted balance per book, so this month's bank reconciliation is done. Thank you.